Hello, and welcome to another episode of the Future of CRE Sustainability. I'm your host, Sean Swentek. Today, I'm speaking with Abe Yokell, managing partner and co-founder at Congruent Ventures. Abe, thank you so much for joining me today.
Thanks for having me, Sean.
Abe, you've been investing in climate tech for 2 decades now. What's the biggest shift you've seen in how the market views clean tech investments?
There's a long version and a short version on that.
I'll take either or.
As a quick personal history, you got it right. I'm 21 years deep in what we used to call clean tech venture. Now we call it climate tech venture. My co-founder and I pulled Congruent together about 8 years ago. And as it relates to this conversation, Omnidian was one of our first investments. We do pre-seed, seed, and early stage investing. I remain on the board of Omnidian, so it's great to be on here today, talking to you and the things that I've been listening about. The biggest shift, I think, over the last 20 years has been when I started, this was the stepchild of energy. It was the stepchild of venture. And the Venn diagram is where we like to invest in these kind of strange areas within these spaces. When mainstream venture started coming in really 2005, it was kind of a new thing that they were examining energy and this clean tech subsector. It built up to 2008, and then everything kind of broke in the GFC, in the global financial crisis, and everybody ran away. And in particular, they ran away from clean tech. They ran away from all venture, but they came back to general tech. From 2008 through 15, 16 or so, we had this period where a lot of these physical assets like solar, like wind, and like these other kinds of technologies like batteries slowly and consistently got cheaper until the point in early 2017 or so, they actually became the cheapest form of net production or consumption of energy. And so when you actually kind of think about the time constants there, we had this period of like excitement, but actually fundamentals weren't that great. It all faded. And then when everything came back into place, we actually had a phenomenal physical and economic layer to build on top of. And the last really, I would say 8 years or so, I think have been characterized by the intelligent thing to do from an economic standpoint has largely been the clean thing to do. And there are a couple exceptions there, but that remains true regardless of the policy environment.
What specific things when you're making your investments do you look for when it's like, this is the right company for us, or this one's not quite the right fit for Congruent?
Every venture fund and investment group has a different methodology to investments. We enter at pre-seed, seed, Series A, so very early stage. We also have a growth fund that sits behind those early stage investments, and the discipline there is very different. So when we invest at the first check, it is oftentimes team and dream. And what that means is we're looking for founder market fit, as in the founders can describe in a very clear narrative what they know about the industry and why their personal backgrounds fit that narrative. We have to have a belief on the actual market potential. And we'll come back to that because there are many very, very large markets in energy and in the built environment. Many of those markets are actually completely inaccessible to venture funded companies. And so big market doesn't mean that you can actually tackle that market. So that is a very key point. And then that kind of channel to market actually is the relevant piece. So it's kind of team and dream. And then it's something that can support a venturable outcome. And so what that means at that entry point is that we believe that you can actually build a business with relatively high margins and growth that is consistent to the venture model, which usually means operational leverage. In other words, if you have to hire a new person to bring on revenue every time, and there's no benefits of scale, there's no economies of scale, then that's probably not good for venture. If you can build a technology layer and build on revenue such that revenue grows faster than your costs, and it's a large, accessible market, that's fair game for us. But when we invest, for example, I think when we invested in Omnidian, and I know this podcast is not about Omnidian, I think there were 3 people. And so we led that first seed round, and that was all about team and dream and the founder market fit.
Yeah, those 3 people still here today. You mentioned 21 years in this space. What brought you to clean tech originally, and what inspires you? Why was this a good fit for you?
Venture capital is this now shiny object. When I started, it was kind of a weird object, but it's become much more mainstream. It's a super fascinating business. to me, it is a strange business that is fascinating, rewarding, but not something that I would dedicate my life to as a standalone. The thing that gets me up every day is that Congruent focuses on decarbonization. It's all climate tech and sustainability. And without that greater purpose for me, the venture would be interesting, but it would not be enough. And so my North Star is really about using the venture model to support early stage entrepreneurs, help grow the ecosystem. And, most importantly, actually, the reason that we pulled Congruent back together back when most firms had left the building was to help prove to the asset manager world, to our LPs, to our investors, that you could actually generate a venture grade return by investing in decarbonization, in climate, and in sustainability. And there was a belief from kind of that 2008 through 2015, 16 that might not be possible. And our mission has been to prove otherwise. And so the real thing for us is that in order to drive sustainable outcomes, our core belief is that they have to fit the financial model. And the double bottom line is important, but actually REs measure us really by that single bottom line. And we have to be able to do both. And we have to be able to prove that this is justified to allocate dollars to versus investing in, the next Uber even.
And I'm guessing some of the inspiration comes from the artists who created your backdrop behind you and making sure there's a functional planet for them in the future.
There is certainly a lot of that, although they've been along for the ride. So, they joined me about midway through the climate journey here. And sadly for them, they don't have a choice but to be on that ride.
As you mentioned, you're really investing in the future of energy and technology. Which trends in climate tech are people maybe overlooking right now that you think are like set to take off?
So we do focus in the United States and North America, and I will caveat that we are somewhat myopic in our view on that. I think it is always interesting to look at those kind of fundamental economics and overlay them with public opinion. And so probably the one that is most fascinating to me is actually EVs. So EVs in particular, they've had a big bull run. I think the challenge is that in the current policy environment, it is popular to say that, EVs are not a thing and that the tax credit's going out the door. That's kind of no net new news, even though at the time of this recording, at least, that has not officially passed. But the reality is that they're now, these EVs in general are so good and so cheap that they're actually better than a lot of gas cars. Not in all the cases, but in many of the cases. Yeah. And if you actually look at the estimates over time on electrification of transportation, even with no incentive, what you see is that there's going to be, certainly worldwide, but even in the US, market share is expected to increase over time. And when you think about the knock-on effects of the electrification of transportation on our power systems, and then you think about, this has gotten a lot of ink spilled on it in the last 12 months, but you think about data center growth on the power sector, our utility ecosystem has not dealt with the power growth that they're seeing for at least 80 years. Mm-hmm. Between industrialization, manufacturing, which was on a bull run before the tariffs fell into place, electrification of transportation, and now data center growth. And the entire utility and power model is under pressure right now. And so there's tremendous knock-on effects that are going to show up in very weird places in the next 5 to 10 years, in my opinion. So it's not like nobody is thinking about that, but I think the whole ecosystem challenge there is not to be understated.
Yeah, it feels like we're in a transformational phase as to control of power. Like the power to the people is kind of becoming a real thing as we see distributed generation power take over for folks in the US. It's pretty cool to watch.
It is amazing. It is also challenging and confusing, particularly for the utility models. Because the reality is that unless you're cutting your cord entirely, you still need the utility to be shipping you electrons.
Yep.
And that makes it hard unless you are oversizing, your solar and your battery systems to dramatic effects. You still need the utility. And so there's still an incredibly important part for them to play in this. but we have to harmonize what's going on in distributed energy resources and the utility, and that is not an easy story.
When you look at your portfolio companies, are there any that are creating outsized value for the business owners that they're serving that have maybe surprised you in their performance?
All of them. I mean, obviously, we haven't so I think we have 54 active companies.
Wow.
Many of them are very young, and some of them are now getting up to 7, 8 years old. And we have many stories to tell about all of our favorite children, and many of them are young. So some of our most exciting are still quite young, and some of our late stage companies like yours are really moving the needle. The ones that have been getting more airtime lately are things like Pano AI, which is doing wildfire AI cameras for shared infrastructure, typically utilities, although municipalities and homeowner associations are picking them up. You folks, obviously, Fervo Energy, which is the leader in geothermal energy, next generation geothermal energy in the United States at this point. We were first dollars there. Muon Space, which is doing a whole bunch of actually satellite work for Earth imaging. AMP Sortation, which is a completely different area, which is in robotics for waste. So they can actually take your straight up municipal solid waste, your trash. They can sort out in their facilities all the recyclables, actually sell off and purify all those recyclables, all the commodities there. They can take all the trash, bring them to the landfill, and then they take actually all of your organics and they can valorize them. They can turn them into biochar, or they can do something else with them. And that's super fun because that would actually and will prevent you from sorting your trash over time while making sure that the diversion rates are very low, meaning your landfills last longer, and that all the recyclable commodities actually get recycled instead of thrown out, which is where sadly the preponderance of what you should recycle ends up anyhow. So, there's a host of these. There's more stories there as well, but there's a lot of companies out there that are making a difference at this point across the portfolio.
You mentioned the built world, and this podcast is focused on really the commercial real estate sector. We're seeing growing interest in commercial solar. It's kind of lagging residential and utility scale, but it's growing. What do you think is driving adoption there behind just straight environmental factors?
I could spend a lot of time on this. We have a number of companies focused on solar and on commercial specifically. Some of which I think one of which has actually been on your podcast. So we were first dollars into Evergrow as well, which I think may have been your first guest, if I recall correctly.
Yeah.
This is a nuanced story, but just taking a step back, if you just think about solar for a moment, there's really kind of three general asset classes, in my opinion, about solar. There's kind of the utility scale, there's residential, and then there's kind of commercial and industrial. And there's obviously differences in C&I, but utility scale has benefited from the fact that most of the off-takers are creditworthy counterparties. And that means that they can find financing. So this has been true for many years. It used to be from portfolio standards, renewable portfolio standards at the utility level. Now, most of the buyers are actually corporate buyers on PPAs, on virtual power purchase agreements. But regardless, there is a high quality credit buyer of the electrons being generated there. And that means that you can finance those very large systems. You can find project finance dollars to dump billions of dollars into those systems. Residential actually is interesting in that you can do the same thing. And this is what's happened really with Sunrun and Solar City, now Tesla back in the day. They pioneered the lease or the PPA model, which are legally distinct, but their whole theory was third-party ownership, where somebody owned it and you either bought the electrons or you took a monthly payment and leased these assets. And they were pooled vehicles. So the reason this was enabled is because of FICO scores. Sean, you have a credit score. You can tell us what it is if you'd like. Find some new mortgages. But we can also probably give you 5 offers on your roof if you've got a qualified roof.
Yep.
For commercial and industrial, you don't have the same system. You don't have an easy point of sale system to actually do credit underwriting. And so that same financial tool set can be deployed for commercial and industrial, but the actually sales and marketing expertise needed to get that done is a lot harder because most of the groups with large rooftops actually can't afford to pay cash, even if they're taking advantage of the existing tax credits, the investment tax credit and the makers, the accelerated depreciation. And so when you actually think about the development exercise for commercial developers in particular, They can be very large projects, but they're really hard to get financed. And that's really kind of what Evergrow is focused on. We have another company called Energetic Insurance as well that is also focused on part of that challenge as well. But the benefit of those systems is that they're actually the best, most economic systems ignoring the financing problems. And the reason for it is you actually have some economies of scale. Instead of putting 7 kilowatts on a roof, you might be putting 50 kilowatts on a roof, which makes things much, much cheaper. And yet you're competing at the retail level. You're already effectively offsetting the electrons that have been generated at wholesale and then sent through transmission and distribution. And so you're actually competing at a higher price point with a lower cost electron. And so fundamentally, the economics are actually much better. And by the way, there's been many studies on this, but commercial and industrial rooftops across the US, probably one of the single largest untapped solar resources in the US. Incredibly underpenetrated compared to resi, which is not overly penetrated. And utility scale is having all kinds of interconnect problems. You can't plug into the grid. So commercial industrial is like the best place to actually deploy solar. The challenge with it is you can't get it financed. And so it ends up being a stakeholder problem, a financing problem, and a go-to-market problem that involves the other two.
What are you predicting for the future of adjacent technologies like battery storage and EV charging?
I would say my biggest prediction is that over time, and this is not happening overnight, but over time, that they are very quickly following the same cost curve pattern that solar has. The cost of storage has gone down dramatically. The cost of EVs is dropping. What's going to end up happening is that you've got, relatively inexpensive resources, all of which have telemetry. They can actually communicate, and they all have compute. And the net effect of that is going to be, I mentioned the word harmonizing. Orchestrating is another word for it. There will be ways to pull these distributed energy resources into the overall energy picture in a harmonized and orchestrated fashion. And there's a lot of different mechanisms. We were, more talking our own book here, but we were first dollars into LEAP, which allows commercial and industrial users in most of the ISOs, RTOs, so like most service territories that are in a traditional energy marketplace, to actually dispatch those assets, the flexible assets, EVs when they charge, batteries when they discharge, into the marketplace. We have another one that's being sold largely to utilities and solar EV and battery developers called Camus, which is really a developer toolset. And that is also an orchestration toolset that isn't market-based, it's more deterministic, meaning when the utility wants to turn something off or on, then they push a button. And it will harmonize all of the various distributed energy resources, into the overall grid envelope.
You mentioned this show is not about Omnidian, but I'd be remiss having an investor on and not asking, what was it about our business model that caused you to initially invest in Omnidian and continue to support us over these last 8 years?
Well, the fun of solar is that in terms of deployment, it always goes up. But in terms of the solar coaster, you always go up and down and up and down and up and down. And, when I first met the founding team at Omnidian, I think I was still with my old firm. It was probably 2015, 2016. Actually, that's a lie. I first met Mark, your CEO, in 2008 when he was at SunPower, and we had actually a co-investor. But, we stayed in touch a little bit. And when he and Dave, who I'd also known separately, showed up, they started talking about this problem that I had been observing, which was fundamentally that these assets that get deployed on rooftops, commercial or residential, they are really great assets. They require very little maintenance. They do require maintenance.
Yep.
Over their 20 plus year life, somebody still has to pay attention to them and somebody has to touch them. And it's like there's no moving parts, but it's still a problem over time. Rats chew through wires, this stuff happens. And there was no third-party service to do that for all of these bundles of, in particular, that started in residential solar. And if you look at most of the financial markets that involve securitization over time, which solar has now gone through, the ecosystem has actually supported third-party servicers to make sure that they're not tied to the origination or the actual development work that is done, the sales work. And the reason for that is because those sales organizations sometimes come and go. I mean, very sadly, there was just a large bankruptcy announced. It is Tuesday the 10th at the moment, but it was announced yesterday, maybe officially. Not unexpected. Not the first this year. SunPower blew earlier this year. And when you think about the many, many stranded assets in Elmonders, those assets are phenomenal. Unless there's somebody to take care of them, they're going to have challenges. And so the bet there, speaking of founder market fit, was we had, Ray was the third co-founder. We had three people who all had complementary skill sets, who understood the market enough to understand this challenge and to build something purpose-built to solve this very specific challenge that over time we believed would become a bigger and bigger problem. And you never want to root for, things going south, because that's a terrible place to be. But the reality over a 20-year asset is that over time, those assets may change hands. And you want a third-party servicer that is purpose-built to help those. And that was the original thesis. Was at the time that we invested, we kind of saw we were on the downward stroke of that cycle. And we thought it made a lot of sense for a high-quality, technology-driven service firm to enter the market. One of the other challenges with your business, if I can say this, is, the O&M work is about high efficiency, high quality work that is done at the lowest possible cost.
Mm-hmm.
The problem with doing things at the lowest possible cost is that if you're rolling a truck to every single problem without remote diagnostics, which is historically how things have been done, that you can't do it at low cost. High quality labor is not inexpensive. And so the only way to do that is technology enabled, which was the thesis behind investing in Omnidian, is to do a technology enabled service, to do as much remote diagnostics as you possibly could, send the right people the first time. If you do a second truck roll, you're cooked. One truck roll you can do properly. But when you think about the fundamental economics of the business, you try to do remote fix first, you roll just once, and you fix the problem the first time.
From your investment perspective, what's the biggest barrier preventing wider adoption of sustainable technologies in the built world today?
It's a stakeholder challenge. It has been consistently in the built environment. We've had, both with Congruent and my old firm, we had many built world companies, the built environment.
Mm-hmm.
And the stakeholder challenge is not new to anybody in the market. It is the groups you're selling to are not necessarily the groups that will actually financially be advantaged by what is bought. And the classic example is not owner occupied commercial industrial space that's on a triple net lease, which is the normal lease.
Yep.
So the costs are all passed through. So what incentive is there for a owner of a building to install a bunch of solar when they're bearing all the cost, but the benefit is actually passed through the tenants? Now, there are many mechanisms around a triple net lease. They all are complicated, and they're all off market. And so, what's going to happen? The same thing has been true for building management systems. I've probably seen no fewer than 30 AI for BMS pitches over the last 15 years. And by the way, most of them work pretty cool. But integrating into all the various vendors, the technology stacks, these BMS systems are super well engineered. They last a long time. Like, do you want a modern one? Is the servicer on record the same group that installed it? Did they want to deal with all of the set points that you're messing with? Probably not. It gets super messy, super fast. And again, who's benefiting from it? Well, it's probably, again, the tenants, not the owners. So then when you actually think about the sales and marketing exercise, let's say you're bringing a new product to market that's focused on commercial and industrial or commercial owners, you might go after just owner occupied. But then the challenge is okay, now my sales world just got smaller. I don't know who is actually owner occupied versus not.
Yep.
If it is owner occupied, how do I get to the right decision maker? And is that decision maker, is it the building manager? Is it the asset manager? Or is it the investor behind the asset manager? So you can figure that out with really expensive enterprise sales folks and data scrubs. And by then you have lost money because you have now paid for a really expensive enterprise salesperson and data.
Yep.
So your cost of kind of customer acquisition for a new product is very, very high. Usually the budgets are not unlimited in the built environment either. And so are you getting enough margin out of that very high expense sales activity? So a long-winded way of saying there's some amazing technology focused on the built environment. The sales and marketing work to unlock the segment is extremely difficult.
How do you think the markets today are mispricing sustainability risk versus opportunity?
There's a lot of different ways to answer that. I think there are some very specific ways when you think about the actual kind of catastrophic and insurance risk. We actually have a fair bit of insurance around the portfolio as well, and insurance related companies. One of our more recent investments, although they have just been growing like a weed, is a company called First Street Technologies. And First Street was actually a spin out of what was a foundation. And for years and years, a private foundation had poured dollars into fundamental research to try to publicly, with the scientific community, build parcel level risk maps across the United States to understand weather risk. Floods is where they started. Fires are now included. Wet bulb temperature risk is also now included. And in fact, if you go to Zillow or Redfin, you can actually look at the risk score that is fed from their platform.
Wow.
And if you're looking at something, it'll say, oh, well, you have a 9 in 10 chance of burning in the next 30 years. Go ahead and buy. But the challenge actually is when you think about that for either a commercial asset owner or a developer, you actually want to know what your risk is. And by the way, the financiers of those, whether it's CMBS or whatever the market is, also want to know the risk embedded in either their mortgage portfolio for residential or potentially in the commercial markets for commercial paper. And that tool is being deployed across banks in particular, but also now getting pulled into some insurance discussions to actually understand fundamental risk. So I would say that probably the biggest fundamental risk, which is really not internalized yet, is that our climate is indeed changing. You don't need to be, a climate scientist to believe that. Many people will disagree as to why, but it is changing. And if you look at the rate of change, it is generally accelerating. And when you think about the risks related to real estate across our country, they're in the trillions of dollars, just climate risks. And so at some point, both the insurance markets, and we're starting to see that in California, but both the insurance markets and the financial markets around these assets are going to have to reallocate their risk and internalize the real risk that is actually sitting on their books. And people are starting to figure that out, but it's going to show up at some point. And I can't make a call whether that point is in 2 years, 5 years, or whether it's going to be a slow motion, reallocation over the next 30 years, but it will show up. And I think it will make an impact. You can see this in many of the climate related insurance markets today. In particular, we have some exposure in a company called Demex that is in the reinsurance market for severe convective storms. And so they provide basically an aggregate risk insurance policy for a lot of the insurers that actually work with, property owners. So they're not directly doing the insurance on it. The challenge that they're walking into and that the gap they're filling is that entire reinsurance market has left the building. They've taken so many losses over the last 5 years in severe convective storms. By the way, it's hail.
Yeah.
So hail damage, which is, not unusual for the solar markets, but they've taken so many losses that the capacity, the reinsurers out there, these large financial institutions have basically said, well, sure, we'll give you insurance, but we're going to charge you, it's called rate online. We'll charge you half as much as you're expected to lose in a year just to insure you that you could lose in a year, just to insure you for that year. And so it's like, all right, I'm getting 100 million of insurance for, some mutual insurance company, and it costs them $50 million a year. And the mutual insurers are like, what? Like, why would I do this? This is absolutely nuts. But that's the price that you have to pay to insure these risks at this point. And so these insurers are actually now exposed.
If you were advising a commercial real estate leader with a large portfolio across commercial and industrial, what's the one sustainability investment you tell them to make today that's going to make them look brilliant 5 years from now?
Yeah, I think the thing that many, didn't used to and now do in commercial real estate is actually look at how much of a swing your NOI can have based on the implementation, your net operating income can have on the implementation of some of these technologies. And so, honestly, solar, it was clearly a little self-serving, is super low-hanging fruit. It is a capital allocation discussion because you have to come up with capital up front or find financing. But, in general, if you've got appropriate roof space, your NOI goes up. If you're looking at any reasonable cap rates, your total value of your assets should go up dramatically just from that. The other stuff has been around for 30, 40 years with lighting retrofits. But the reality is if you take an approach, a thoughtful approach, an ROI-driven approach of what you can do to enhance, your energy efficiency and therefore your incomes, it's rare you find something that doesn't pencil. And then the question is access to capital to make those investments. And that can be more of a challenge.
Abe, you're one of the more active and participatory board members I've come across in my career. What do you see as the role you can play in helping the businesses you've invested in navigate customer satisfaction and decision-making processes and operational excellence? What do you think you bring to the table there?
As board members, what we really try to do is our day job is not to be in your shoes. Our day job is to make sure that the shoes are filled. And so by that, I mean, over time, we talked about your founders. You started with, 3 execs. They're still all doing great. They're still all present. Your exec team has grown tremendously. And so, my view is that as a thought partner to founding teams, our hope is that we will be along for the journey to think about organizational behavior, about when new execs are needed to fill certain roles, what those org structures look like, and how you capitalize the companies over time.
Yep.
So these things aren't free to grow. Hopefully you grow mostly on margin from the revenue generation. But in our world, of course, a lot of dollars come in from investors to make sure that the companies are appropriately set up to deliver customer value. And so our job is to really help, the senior team think through who needs to be where, when, help them think through how to recruit them if they haven't been through that before, and make sure that organizationally things are productive. And, one of the truisms across every business is that if you're not serving a customer and the customer isn't happy, you have a problem. And sometimes these things get masked if you've got like a super high velocity sales org that keeps on building and your old customers churn and you kind of fill them back up. Eventually that all falls apart. And so, customer satisfaction, engagement, product for customers, all of those things are part and parcel for building a healthy long-term business.
Taking it up a level, what do you see for the future and sort of near-term future for venture capital, given kind of some frothy macro conditions?
Venture capital in climate or venture capital broadly?
Whichever you prefer to go down.
Well, I can hit both quickly. Venture capital as an asset class at the moment is a have and have not game. There is a huge amount of capital getting dumped into AI, and not like the building management system AI, but in LLMs, ChatGPT, these kinds of systems, to the tune of, many, many times, I have seen. It is kind of nuts what's actually happening in terms of capital flows within AI. Outside of AI, it's actually pretty quiet. And one of the underlying challenges is actually in the LP base and our investors that support us. There's a whole host of different kinds of LPs out there. There's pension funds, there's endowments like university endowments, there's sovereign wealth funds, there's a lot of family offices, many different kinds of large institutional LPs out there. One of the groups that has historically supported the venture industry the most has been the large university endowments. This is the Yale model. Those endowments at the moment with current administration policies are under tremendous pressure. There's an endowment tax that's showing up for the first time. Those were historically tax exempt. Everybody's trying to figure out what to do with that. And there's also many grants that are being canceled. And so those endowments, combined with the fact that they have a very high private equity and venture allocation across their, couple $1 billion portfolio, say, that is not producing a liquidity. Nobody is selling anything into the public markets. The IPO window is closed right now. And the M&A market is also pretty quiet. So there's no liquidity being produced by existing portfolios, and they have cash needs. There's a period for the next couple of years where they are going to be reallocating their dollars. And so it's actually incredibly difficult to raise a new venture fund right now. If you're a long-time venture firm and you have established LP relationships, you'll be fine. New venture is challenged. And climate as a broad asset within venture is also actually not that big. You have a couple, of the best, of course, on your cap table as your investors. But the reality is that there aren't that many climate venture firms. And there are a lot of kind of net new venture firms within climate. We need many, many more. And so it's going to be interesting to see the next couple of years of kind of capital activity within climate venture. We feel fortunate to have a very fresh fund, and we're on effectively our fourth fund at this point. So we feel like we're in good shape, but it's uphill sledding for many right now.
Lots of opportunity with you sitting on dry powder, so that's a good sign for y'all. Let's move to some lightning round questions. So just quick answers, quick hits here. Solar, wind, other. What's your bet for fastest growing renewable energy source 5 years from now?
Solar's going to keep on hacking at it. It's unstoppable. If you look at the history, this is not a lightning answer. If you look at the history of solar and the projections get it wrong every time, it just keeps getting cheaper.
What's the one investment in your career that was the biggest surprise winner for you?
I'd probably go with Enphase Energy. It wasn't a surprise winner. The reason for it was a surprise. So when we invested in, I was part of the deal team back in the day that invested in the series, can't remember series, is like one of the first institutional rounds. We saw like 25% more production from these microinverters. We'd looked at 8 of them. Enphase was clearly the front runner on the whole thing when we made the investment. And I was still in stealth. And my energy nerd brain was like, this is so cool. You can get 25% more out of the same system. And then they went to market. The installers didn't care. They're like, that's cool. It solves some tree problems. But what's really cool is that it makes the design of these residential systems, that's where they started, super easy.
Yep.
I carry one SKU. I don't have to think about all these strings. I just kind of throw them up there. The install is a little bit different, but it's about the same time. And it was actually the channel that adopted it and pulled it through. So I'm not surprised that they won, because the team is and was awesome. I was surprised at why. Like, I just got that wrong. I was like, wasn't even close.
Where do you think renewable energy nets out in this current political climate?
I think there are areas where the policy can really impact to the negative. The wind stuff on BLM that was announced, that's a problem. It's really quite a challenge. I think what the reality eventually will prevail, and whether it's in this administration or the next, I couldn't tell you. But the reality is that if you look at how quickly you can drop new generation onto the grid, renewables have a 2 to 5 year time frame. By far the fastest. Nat gas for actually combined cycle, so more efficient. The lead times on those systems are 5 years, ignoring any air permits.
Yep.
And nuclear is 10 years. I love nuclear, actually. I know that's controversial to some, but I'm a huge nuclear, fan. Not relevant. Not getting done for at least 10 years. And we have such a demand problem in the very short term that the only way to go is solar. Solar and batteries, a little firming. Geothermal, of course, will solve some of those problems, but there's only one way, and there's only one way to solve it. It isn't just with fossils. You can't, no matter what you say from a policy perspective, unless you were just giving dollars to coal operators, just because you say you want coal operators to operate doesn't mean that they're going to operate.
All right, last question. If you had a bunch of your own free capital to invest in something early stage today that you really believe in, what would it be?
I can't really answer that question, because, it would either out somebody who's doing something
Fair enough.
or insult the rest of my portfolio. And so I'm going to dodge that last one.
That's totally fair. Abe, if anyone who's listening wants to learn more about you or what you're doing at Congruent Ventures, where's the best place for them to go?
We're not yet digested entirely into ChatGPT, so it's just congruentvc.com.
congruentvc.com. Abe, thank you so much for joining me on the show today. This was a really enjoyable chat for me. For all my listeners, thanks for tuning in. I'll see you on the next episode of The Future of CRE Sustainability.